Canadian Investor Scores. Terms of use and disclaimer. The content of all videos or articles produced by Financial Literacy Learning Center are for educational purposes only. All ideas, opinions, and/or forecasts are for information purposes only and should not be construed as a recommendation to invest, trade, and/or speculate in the markets. Any investments made in light of these ideas, opinions, and/or forecasts expressed or implied herein are committed at your own risk. Video or article content are for educational purposes only and not a recommendation to buy or sell any securities. We believe in the use of an investment professional before investing. Not all advisors are alike. We can assist you in matching advisors with what you may be looking for. We strongly believe that the majority of investors require assistance from an investment professional. We hope you view our video on the investment industry to fully be aware of all the various licensed investment professional types in Canada, along with their fees and/or compensations as well as their services. You may not read or use any of the services of this site unless you fully agree to and understand the terms of use and disclaimer posted above. You must read the terms of use. The FLLC is strictly in the education business. Instructors who work in the industry are not to discuss their firms in these videos or articles. FLLC does not sell any investment products. This course complements Canada's Task Force of Financial Literacy that has been launched by Canada's Ministry of Finance, James Flaherty, in June 26 of 2009. So in this course, we will cover introduction. Session 1 will cover income investing. That will cover short-term investing. And session 2 will go further into income investing. That will cover medium and long-term investing, preferred shares, and dividend tax credit. And then we'll also talk about how you can profit in the bond market. In session 3, we talk about equities, which will cover capital markets, the stock market, various commodities, REITs, which are real estate investment trusts, and income units. And session 4, we'll talk further about equities. We'll talk about finding stocks to buy or sell. And in this section, or this session, we'll cover balance sheet and view. We'll cover fundamental analysis, ratios, and technical analysis. In session 5, we'll dive into the economic cycle, where we'll talk about how economic cycle relates to stocks, bonds, real estate, and commodities. We'll talk about the yield curve, which we believe is a valuable warning signal in any economic cycle. In session 6, we'll talk about what a simple financial plan is, where we will talk about a balance sheet, how much money do you need, reality, and human nature, how it affects your financial plan. And we'll continue on financial planning in session number 7, where we will cover annuities, terms versus universal and whole life, sheltering money, and tax strategies. And in session 8, we'll talk about the investment industry overview, where we'll briefly talk about who the players are, the licensing bodies, and how the players get paid. In session 9, we'll cover investment industry further, but we'll talk more about fees in this session. And we'll give you a good foundation on investment account fees, investment product fees, and guideline to help you choose. And in session 10, we talk about packaged investment product. In this session, we'll cover 3 products: mutual funds, wrap accounts, and ETFs. which are also known as exchange traded funds. In session 11, we'll continue on packaged investment products. And in this session, we'll talk about guaranteed income products, closed-ended units, and structured units. In session 12, we'll go a little deeper into investment products, where we will talk about options. How do they work? How can you use options as a conservative strategy? We'll also talk about how you can use option to generate income. In session 13, we'll talk about portfolio management, or how you can construct an investment portfolio. We'll talk about two key areas of any investment portfolio, which is asset allocation and how you can construct a customized investment portfolio considering all the relevant factors. In session 14, we talk about investment strategies. And in this session, we'll cover whether a balanced fund or portfolio is risky going forward. And we'll also talk about buy, own, and hold investing, why you should do it or why you should not do it. In session 15, we'll talk about rules-based investing as one of the investment strategies, where we will cover fundamental and technical analysis. And in session 16, we'll talk about measurements, where we will cover the Federal Reserve, long-term indicators to watch. And then we talk about psychology in session 17, where we'll talk about you, which is the most important piece of the equation. And then we talk about you and your advisor or planner. We also talk about what is investing all about. Investing involves some level of risk, no matter which product you're investing in, which market you are investing in. We'll cover risk investing versus guaranteed. We'll talk about investing helps manage inflation. And investing attempts to grow your money. Investing involves knowledge, patience, and discipline. When we do investing, we always have some investment objectives that we have to keep it in mind. The most important objective in any kind of investment is safety of principal. Safety of principal means how much are you willing to lose, or how important is it for you to make sure that you do not lose any amount of the original principal that you have invested. The second objective is income, which means when you invest a certain amount of money, how much of income you need on a periodic basis, whether monthly or yearly basis. And the third is growth. How much growth do you need from your investment? And then we talk about liquidity. Liquidity means, is your portfolio able to raise cash or switch between investments easily? Take, for example, stocks can be easily bought and sold, but when it comes to assets like real estate, it takes time for you to sell them. So there is more liquidity risk involved in something like real estate versus stocks. And the other investment objective we'll talk about is knowledge. Know what you're doing and what you own. Access to product. Put yourself in a position so you are not restricted to the investments you need. What are the risks? There are 5 risks in general: liquidity risk, interest rate risk, inflation risk, reinvestment rate risk, and bankruptcy risk. Liquidity risk, as I mentioned in the last slide, is in a case where you may not be able to sell your investments quickly. Again, taking the same example as your house or any other real estate property, it takes time for you to sell. You cannot sell it at a moment's notice, like most of the stocks listed on stock exchange. And then we talk about interest rate risks. Interest rate risk mean any changes in interest rate may reduce the market value of a bond or security that you hold. Inflation risk. Inflation risk means your investment won't be worth as much in the future because of changes in the purchasing power due to inflation. Reinvestment risk means any proceeds from payment of principal and inflation may have to be reinvested at a lower rate than the original investment because the market conditions may not be as favorable as the time when you invested your original principal. Bankruptcy risk is very obvious, which means the stock or security related to a company may not be worth as much or may be worth less because the company may be unable to meet its debt obligations. So it means likelihood that a firm will become insolvent because of its inability to pay the debt. And here we talk about risk range. The most risk that you face in investments would be in futures and options, and then in common shares, real estate, and precious metals, and then it goes down to preferred shares, corporate debt, GIC, government bond, and the least risk that you have is money market, which is treasury bills issued by Government of Canada. Age can also play a huge factor in terms of how much risk one should be taking. Take, for example, somebody whose age is between 20 to 35 has a higher risk tolerance. Because if he loses a amount of principal or amount of money in an investment, he has a longer time horizon to recover versus somebody who's 71 who does not have any time horizon because he has to rely on the principal to generate the income that he can rely on because he does not have an income source like a 25-year-old man. In the same way, somebody who's 36 to 49 years old will have medium to high risk, and 50 to 65 will have low to medium, and 66 to 70 will have a low risk. So here's the contact information. You can contact Jerry Gavin at askjerry@trustedwealthprofessionals.com, and his telephone number is 905-203-1162. And to connect with the local wealth professional, please enter your postal code on the website listed below. It's www.trustedwealthprofessionals.com.